Evidently, it's the week of economic studies, with the market delivering to us yet another PEA to take a closer look at. The latest study comes from a retail favorite, Victor Cantore's Amex Exploration, who has been working on the development of their flagship Perron project, which is found in the heart of Quebec's Abitibi region, one of the most prolific gold belts globally. So you can probably imagine what the economics look like on this one. Let's dive in. Amex Exploration has released a preliminary economic assessment on their Perron project, but it comes with a bit of a disclaimer. This isn't the first PEA conducted on the property. In fact, the last one isn't even a year old, with the original PEA being released in November of last year. But management wasn't happy with the results of that study, so they went back to the drawing board, updated their resource estimate, and reworked the study to come up with an operating plan that has a lower initial capital cost, pulls more gold out of the ground, and has a longer operating life, with the added bonus that the study could reflect the higher price of gold, thereby improving economics. So what exactly did Amex change over the course of the last year, and why? Well, first and foremost, it appears that they wanted a lower initial capex number. There's some benefit to this. First, it makes the economics look great because lower capex means a quicker payback period. Second, for shareholders, it reduces the dilution required to get the project into production. Lower capex inherently means less money needs to be raised or borrowed before that first gold comes out of the ground. And that has a positive impact on the cap stack, meaning long-term shareholders could potentially get a better reward at the end of this entire cycle. Initial capital required between the old and new version of the development plan moved from $229 million to just $78. Although that figure includes $69 million in pre-production revenues that offsets the large $146 million in initial capital estimated for what is actually needed here. Second, this initial capital reduction is the result of one major change. Amex is taking a phased approach to production. Rather than coming out of the gate at full tilt, two phases of operation are now expected to occur, with the first consisting of toll milling, which will fund growth capital that enables the operation to construct an on-site processing facility, and given the location of Perron and one of the most prolific gold belts globally, Cantore and his team essentially want to take advantage of that fact and use some of the currently underutilized milling capacity in the region to their benefit, because it is fiscally the prudent way of going about things, and it also reduces permitting and technical risk, which are both positives. All right, so let's get into the details here. Under the revised development plan, two phases for production have been outlined at Perron. The first phase, which is expected to be in place for a period of 4 years, will see Amex extract 1,000 tons per day from the Perron project. Underground mining is the primary focus here, with longitudinal long-hole stoping the extraction method of choice. However, open pit mining will also complement the operation, with a total of 7 pits included in the mine plan, with those pits to begin being mined at the start of Phase 1 operations. Average annual gold production under the Phase 1 mine plan is estimated at 102,000 ounces of gold, with average diluted head grades of 10 grams per ton, resulting in 410,000 ounces being pulled out of the ground under this phase of operations. Pre-production will occur for 21 months prior to Phase 1 being entered, after which Phase 1 will commence. Both pre-production and Phase 1 mining under the current development plan are expected to be conducted by a mining contractor. However, Phase 2 has been designed to use a fleet of owner-operated equipment. Phase 2 is to then consist of a 2,000 ton per day operation that will operate for a 13-year period. And although the scale is bigger here, mining will focus on a lower grade portion of the deposit, with average diluted head grades here of 4.3 grams per ton gold. A total of 93,000 ounces of gold are expected to be produced annually under this stage, with 1.25 million ounces of gold to be extracted under Phase 2 of operations. Phase 2 of operations appears to be predominantly underground mining focused, with the open pit mines expected to be fully mined by year 13 of operations. The pits are planned to be used strategically and have been sequenced to allow for the tailings generated from the Phase 2 on-site mill to be deposited within them. Overall, a life of mine here is estimated at 17.5 years, with average annual production over that entire time frame sitting at 95,000 ounces. Over the entire life of mine, a total of 1.7 million ounces of gold are expected to be pulled out of the ground, with average annual production in the first 10 years of 112,000 ounces a year. Moving on to the processing plan, processing under Phase 1 is rather straightforward. It's not their problem. Okay, it is, but you get what we're saying. On this front, Amex appears to be wasting little time in moving the project forward. While no toll milling arrangement has been officially signed, discussions are already taking place for the treatment of Perron's ore under the first phase. Several parties are said to be interested in processing the material, and there seems to be an abundance of available capacity in the region, which is a big positive. Amex has also had their material tested by a mineral processing consultant in Quebec, who is confident that a number of mills use flow sheets in the region that will lead to recoveries of 94 to 95% for the ore, matching expectations for the on-site processing portion. For phase 2 of operations, a 2,000 ton per day processing facility is expected to be constructed on site, which will operate from year 5 through to the end of the life of mine. The flow sheet here calls for primary crushing, followed by a grinding circuit with a grinding mill and a ball mill. From there, the ore will move to a gravity circuit before a carbon in leach circuit is used. From here, recovery will consist of an adsorption-desorption recovery circuit and electrowinning, before the recovered gold is ultimately processed into bullion bars. Recovery rates from this process are estimated at 95%. Tailings, meanwhile, as we said earlier, will be thickened and pumped to the mined-out pits sequentially for permanent storage. As you can imagine, from a phased approach, the costing here is a bit phased. Initial capital is estimated at $146 million for Phase 1 operations, which is to be offset by an estimated $69 million in gold credits that are to be earned from pre-production, bringing initial capex to just $78 million. That initial capital is expected to be used for the construction of the gatehouse and service and haulage roads, temporary buildings for the mining contraction, a 6.5 kilometer long electrical transmission line, surface water management facilities, mineralized material loading facilities, and of course the underground mine portal and related ventilation systems and waste dump and overburden storage facilities. Growth capital expenditures, which are earmarked for Phase 2, are then estimated at $192 million, which includes the cost of construction of a 2,000 ton per day mill on site, required infrastructure for tailings management, numerous buildings including a maintenance shop and admin building, and of course the underground mobile equipment fleet. Sustaining capital, meanwhile, is estimated at $386 million over the life of mine, the majority of which is attributed to underground development. On an operating basis, Phase 1 is expected to see total operating costs of $529 million, or roughly $943 per ounce. All-in sustaining costs under Phase 1 are estimated at $1,165 an ounce. Phase 2 of operations, comparatively, is expected to see $1.5 billion in operating costs over that 13-year life. But things come down on a unit basis, with operating costs on a per ounce basis coming in at $874 an ounce, while all-in sustaining costs are estimated at $1,027 an ounce. Finally, over the life of mine, operating costs on a per ounce basis are expected to average $891 an ounce, while AISC is estimated at $1,061 an ounce, making this a low-cost operation relative to peers. By now, you're probably tired of me rambling on, so let's get to the good stuff, the economics. After going through the effort of revisiting the PEA and reworking the development strategy, Amex has seen the Perron project assigned a net present value of just over $1 billion on an after-tax basis, with an internal rate of return of 70% and a payback period of just 1.4 years. That estimate is based on a gold price of $2,500 an ounce and a discount rate of 5%. But of course, spot's nearly $1,000 higher than that base case figure. At $3,500 an ounce gold, the NPV jumps to $1.8 billion, while the internal rate of return goes to an eye-popping 108%. And quite frankly, the payback period is tough to believe, with it sitting at just 0.4 years or 5 months, which is literally not even 6 months of operating. So the chances of this operation not hitting production are close to zero, at least in this gold environment. So if you are a shareholder, I would imagine it's just a matter of time. Okay, so let's wrap it up. As for next steps on the project, permitting is already underway with an environmental and scoping study currently in progress. Amex is currently targeting first revenue in 2028, which is actually a pretty accelerated timeline, at least in this industry. But if we're being honest, we'll be shocked if Amex manages to even get Perron into production before getting taken out by a major, because those economics are just too enticing. And the location of the project really couldn't be better. But that's a topic for a different day. All right, everybody, thanks for watching. If you're checking out our channel, we're going to have lots of content from Beaver Creek coming up this week. So if you like mining interviews, we're going to have lots lots of them. Also, if there's stories you want us to cover, as always, let us know in the comments section. I got a feeling that there's going to be some big ones announced at Beaver Creek because that's usually where the deals start flowing. Also, if you enjoyed this video, do me a favor, smash that like button, subscribe, and ring that notification bell. All right, everybody, thanks for watching.